fundsupermart.com.
Hello everyone, welcome to our webcast. With us today is Peter, the Client Portfolio Manager at ING, to share with us his views on Asian debt. Hello Peter, thanks for joining us. So markets remain volatile over the past 2 months. How would the global uncertainties weigh on Asian debt?
Well, the uncertainties are clearly going to continue to have a heavy impact on our markets here. Asian fundamentals remain strong, albeit we are in a bit of a challenging environment, but on a relative basis versus other parts of the world, Asia still looks good and we remain constructive broadly on Asian debt. The European crisis continues to be ongoing, however, and so until the risk from Europe can be reduced, all markets, all risk classes are going to feel a bit of uncertainty, and that's going to clearly weigh on the direction where the markets go. European regulators have a lot of wood to chop, a lot more work to be done. Obviously, they're meeting now. And unfortunately, we're still not getting a high sense of clarity as to what the resolution will be from this point forward. The good news is there's a lot of effort and energy being put towards resolving the crisis.
So in your view, what are the main drivers for Asian debt over the next 6 to 12 months?
Clearly, as we just talked about, European situation is going to be an overarching theme for the markets here, but without belaboring that point, we can look at some other areas. China is going to continue to play an important role both in Asian growth as well as global growth, and so we're watching that closely. We do remain constructive on Chinese overall growth and generally are constructive on certain segments of Chinese hard currency debt. So we're not forecasting a hard landing in the Chinese economy. China has forecasted 7.5% growth. We're looking more towards a number of roughly 8%. Then another theme that we're looking to play out in the markets is just the pent-up demand for Asian bonds in general. We do find that on a global basis, investors are largely underallocated to this asset class, and we do think that Asia and more broadly emerging markets has a lot of opportunity for increasing flows into these asset classes. However, with all that's going on in the world around us, all these uncertain externalities, that demand will remain on the sidelines for now. We hear reports about cash being built up in portfolios and so forth. So we do think that it's there, and we expect it to come into the market. So when the markets start to feel a sense of optimism, as we start to get clarity on what's going to happen in Europe, then we could see some pretty interesting movements in the positive side for Asian debt.
And which countries or sectors are you more in favor of?
At the moment, in terms of a country allocation, we quite like Indonesia. Indonesia, of course, came under a lot of pressure in May. With the global uncertainty, a lot of investors were seeking to flee the Indonesian risk assets, and so every category of Indonesian asset came under pressure in that month, but has recuperated quite a bit in June. But at ING Investment Management, we really take a bottom-up fundamental approach to investing, and so a lot of our positions are driven by our bottom-up individual security selection, and through that selection, we find ourselves an overweight position in oil and gas sector. We also quite like subordinated debt from banks, some of the strongest banks in the region, out of Malaysia, out of Taiwan, out of Singapore. And so that's another sector that we find ourselves in an overweight position in. We choose the subordinated debt because it offers attractive yield enhancement. And more recently, we increased exposure to Chinese companies based on our conviction that economic growth will begin to rebound in the second half. We do think that the second quarter of 2012 will be a relatively weak quarter for China.
On our platform, the fund has constantly outperformed its peers over the past 5 years. Would you share with us your investment strategy?
Well, I think the long-term outperformance of ING's Asian Debt Hard Currency Fund really can be attributed to our strong investment process, a commitment to that investment process that's been proven over time. And one of the key factors driving that process is bottom-up name selection, as I just mentioned. We also have a large and experienced investment team. Now, I mentioned large because that allows us to specialize by various segments of the market. So we have an expert in local currency rates, experts in FX, expert in hard currency sovereign and quasi-sovereign bonds, and then as well as we have a team of credit analysts looking specifically at Asian corporate credit around the region.